Hello everyone and welcome to your Glassnode video report for week 15, 2022. So what we have seen this week is a bit of weakness creeping in. We have not seen the real follow through, new investors coming in, new interest, new hype. We haven't seen the follow through in both buy side and accumulation that we've seen in the last couple of weeks. And this is okay. It's about understanding the process of what is going on. And we're going to explore this in more detail over the course of this session. So there's a saying that I normally keep in the back of my mind, which is that markets are a process, not a result. There is never a one-to-one correlation between the behavior you see yesterday versus what's going to happen tomorrow. They take time. These things are a process. And what we've really seen this week is a pullback after we didn't see the same amount of accumulation follow through compared to what we've seen over the last couple of weeks. So what we're going to look at here is the weakness, particularly in on-chain metrics. I like to use things that are actually quite simple, like transaction counts, active addresses. They tell us a great deal about who is coming into the market and why. And we're going to focus on those to really just understand this user inflow and more or less determine that we remain inside this hodler-dominated market. The last price appreciation is not being the one that's bringing in a whole lot of new users. So we're kind of waiting. We're still in this limbo land where it is that hodler dominated market. There has been some profit taking coming on, which is creating a little bit of a headwind over time. And what we're going to do is just explore these different dynamics as they go. And we're also going to dive a little bit into some nuance on a couple of more fundamental type metrics. The first one, we're going to look at things like why are the transaction fees so low? We're going to look at things like SegWit adoption, look at how that's actually expanded over the last couple of years. We're also going to look at the mining market because even though we've seen our second 50% plus correction, and we've seen these prices continue to fall, plus the halving and low transaction fees, intuitively people would think, well, the mining block reward surely can't be providing enough security. And yet we see hash rate and difficulty continuing to push at all-time highs. So we're going to explore that dichotomy between how we can have an all-time low of BTC denominated block reward, but an all-time high in mining related metrics. We're going to try and explore this at a more fundamental level. So as per usual, please do give us a like and a subscribe. It does help this channel get to more people. And I just want to give a big thank you to everybody that I met and saw our talk at the Bitcoin 2022 conference. It really was a pleasure to meet you all and great to hear all the good feedback about these videos. So I'm glad you're enjoying them and I look forward to making more of them. Let's get started. Okay, so here we are in the week on chain 15 dashboard, and we've been talking about this consolidation now for a number of months. It is now a multi-month consolidation period, and following such a large 50% plus correction, it had the potential to be a bottom formation and actually push higher, which it looked like it might have done last week. But unfortunately, it's starting to now pull back into the range, and we have to keep in mind, is this forming into somewhat of a bear flag? So again, markets are about understanding how these processes play out over time. Nobody knows the future. What we're trying to do is look at all of the data to try and suggest exactly what's going on and just try and establish what is the most likely outcomes on either side. So if we look at our accumulation, we did see a great deal of accumulation. It was a little bit sporadic. It was off and on. We had a lot of oscillation in the values. We saw a large amount of accumulation, particularly last week. And a lot of this was driven by a couple of entities like the Lunar Foundation Guard. There's even been announcements from MacroStrategy. There's a number of these kind of larger entities, but what we haven't yet seen is that kind of follow through in the overall accumulation. We've seen this rally higher, but really we saw and there was enough sell side to essentially pull us back down into the range. Now remember that we've still seen, that doesn't negate the fact that all of this accumulation has occurred between that roughly 35,000 up to about 42. That remains a level where we've seen a great deal of accumulation. Many coins have their cost basis there, and it remains to be seen whether those same investors actually step in to say, well, this still remains a value zone, or is their conviction tested to the point where they start to reverse that position? So first of all, let's go through the process of looking at the on-chain activity, try and establish a little bit about who the investors are who remain in the market. Now I've got 4 metrics plotted out here. We've got our active addresses and our number of transactions, which again, if you're a standard or advanced user, you will have access to. And we then have the more advanced versions of those, which is our tier 3 equivalent, which is the number of active entities and our number of transactions on an entity adjusted basis. And again, what these more advanced metrics do is they clean a lot of the data. They take out a lot of the exchange internal transactions and internal wallet shuffling. So they're a little bit cleaner on the signal, but as you can see that we have more or less a very, very similar pattern. So you can absolutely still garner many of these exact same insights just using these different metrics. So the first thing we're going to start off is our number of active addresses. And what we can see is a very, very clear hype cycle. And actually, let me just zoom this all the way back to the full scale. You'll see this across most of these metrics, but we can see it very clearly here. You will see me often take the 2016 halving or in around that zone as a bit of a cutoff for what I would consider ancient history and modern history when it comes to Bitcoin. And you can see that active addresses was just in this parabolic advance all the way up into the 2016 run. We then had our bull market where we saw an explosion of hype. You could argue this is a continuation of that parabola. And then we had an absolute demand destruction. We saw people leave the network and it took them a long time to come back in. In fact, it took them until the next bull run here in 2021. But you can see that we then moved into this kind of bear market phase, and then we had a bull market phase, and then we've since corrected back into that bear market phase, in this kind of bear market channel over the long term. So this is why you'll often see me take this slice here at 2016 onwards, because this is where we start to move into this regular base load of users with these hype cycles that come in over and above that. So it is one of these things where we can kind of see that there is this long-term bear market channel that's been established. And right now, we saw a little bit of an uptick in terms of overall usage. We can see it here in our transaction counts. We had an uptick on the rally from July into the all-time high in November. We had an uptick on entity-adjusted transactions and on active entities. But what we didn't see was an all-time high in any of these metrics. In fact, it was a far cry from that. So certainly we've recovered from the lows that we had in July. July really was the bottom, the absolute bottom of people caring about Bitcoin. We have seen that that was the maximum point of flush out. Realistically, at the very, very bottom, the most number of people hated Bitcoin. It's kind of this contrarian style indicator. Now we've seen, as with price, it normally does, it brings more attention and hype. People get re-excited, but what we didn't see is the same kind of bull market run. In fact, it looked a little bit more like 2019. It was a bit of an uptick in activity, a bit of a pullback, and then a lengthy consolidation or a reaccumulation period that more or less trades sideways, a little bit down. We did have the March 2020 event, but you can see that through all of that, we had a fairly consistent and sideways period of, the same people. This is the hodlers. These are the people who really don't care about the price of Bitcoin. They're less price sensitive, and they're essentially accumulating rain, hail, or shine. Now, in all of these metrics, you can see that we have a very similar pattern. We're essentially trading from the all-time high down a little bit, but more or less sideways. And we don't really have a major uptick. There's a bit of an uptick recently, but really there's nothing to write home about. Maybe active entities are showing a little bit more excitement, but really what we want to see is follow through from all of these metrics. We've still not yet seen that uptick in overall user base. Now that's okay, because remember that we'll normally see that uptick as we get into the later stages of a bull. You can see that we really only got the uptick here after March 2020, which is a real piece of fundamentals, a changing of the overall macro environment that initiated people's awareness of Bitcoin. So perhaps we need to have something of that nature. Perhaps we need to have that catalyst. But generally speaking, when we start to get that uptick in on-chain activity and we really do start to trend higher, it is coincident historically with these more bullish periods. So that's something to just be paying attention to. And remember that as we trade sideways, hodlers managed to hold the line back here at 30,000, then again here in this 35 to 45. Now that doesn't mean that prices can't trade below that, of course. But it does show that that's kind of it. Let's just kind of work out what is our base of users in the network right now. They are people who saw value at 30,000 back here in July and people who saw value in the recent consolidation phase. That's who we have. And really it comes down to them to really put in that floor as we move forward. So that's kind of the takeaway from this. A break higher shows more users coming in. A break lower would be less constructive and show that we perhaps are starting to lose some of that attention over time. So that's a couple of things to be paying attention to. And I would recommend you check out our Onchain 101 on on-chain activity, which I explore this in a great deal more detail. So I mentioned before that transaction fees is, it's a combination effect. We're going to look at this from a more fundamental perspective. It's somewhat market driven, but there's also technical elements to this. So there was a Galaxy Digital paper that came out recently that was talking about transaction fees, which was really, really good. It was very interesting. You'll find it inside the week on chain. And what they really talk about is all the different mechanisms, whether it's transaction batching, adoption of SegWit, all these things that essentially make block space more efficient. If we can fit, remember, each block is 2 megabytes, 4 megabytes with SegWit. All of these space-saving technologies allows us to put more transactions into each block and therefore increase Bitcoin's efficiency, which is really investing in Bitcoin's future. The trade-off to that is we are going to see this reduction in transaction fees. And you can see that it's been very, very low, essentially, since the bull market more or less ended back here in May. Now, there's a number of layers to this, and I just want to touch on 2 different ones. The first one is the concept of SegWit. So SegWit does create data storage efficiency. It makes each transaction smaller by separating all the transaction data from the actual signatures, the cryptographic signatures. Now, what we have here is our SegWit adoption metric. Now, we've got 2 different versions, and you'll find a link to the paper where we explore this in more detail in the description below. But what we can see is that there was a very big uptick in both adoption and utilization of SegWit. A number of wallets implemented the software, and now we're seeing that space-saving efficiency start to uptick. We're getting up into the 85 and the 75% of overall adoption of this new space-saving technology. And note that this happened pretty much at the very, very bottom of this correction. So as we move into June, we start to see, not only have we seen a complete flush out of users, as we saw in our on-chain activity, which is obviously going to reduce demand for block space, we also had a space-saving efficiency technology come to the fore. And we can see in the green and the blue, which represent the amount of spending UTXOs that were spent that used SegWit technology, we can see also that there's a massive explosion of usage, which is really supporting this story, a massive explosion of usage following that June point in time. So really, the reason why we have transaction fees so low is a combination of effects. Exchanges are incentivized to do transaction batching, putting lots and lots of customer withdrawals into a single transaction to save space and fees. We're seeing SegWit adoption increasing in terms of different wallets that are actually implementing the technology. And importantly, we've seen a flush out of users, which we absolutely did not see the same re-influx of demand and hype and attention and requirement for transaction space as we saw during the bull market. So it really is the reason why we have transaction fees so low. It's a combination effect of both technological efficiency gains and also of users that have just simply left the network. And this is just part of the reality of the market structure that we are currently in. Now, when we factor that in, you would think that an all-time low of transaction fees is going to be bad for mining because that's less revenue. Simultaneously, we've just had a halving back in May 2020, which was brought it down to 6.25 BTC. So if we look at that, that's the lowest block subsidy, 6.25 BTC per block, and a pretty much all-time low of transaction fees. And many would think that that's going to be very negative for Bitcoin's security model. Now, the thing that we need to pay attention to is that miner revenue, the actual expenses that miners incur and what they're actually using to make their economic decisions is typically fiat-based. They're using their fiat currency to buy their power, to buy their hardware, to pay their staff. This is to pay their taxes. All of these things are fiat denominated. So when we look at their revenue, we actually need to consider it in terms of what are they sensitive to. They're sensitive to the US dollar price of that revenue. So even though we have an all-time low of total block rewards in BTC terms, here after the halving, $8.5 million per day was being paid to miners in dollar-denominated terms. Now that's immediately following the halving, 6.25. There was a little bit more transaction fees going on at that time. But here we are with that same block reward and all-time low fees, and miners are being paid somewhere on the order of $40 to $45 million a day. So we can see that that's almost a 5x uplift in overall revenue that's going to the mining cohort. Now, we also have to factor in that during that time, our mining hash rate has expanded. So it becomes increasingly competitive. There are now more miners fighting over that same profitability. So when you factor that in, it's not 5 times more revenue per miner. It's actually close to about 150%. That's that competition squeezing down the margins. But what is really, really important is that the hash rate and particularly the difficulty adjustment, they're currently sitting at or around all-time highs. So even though we have had the halving, even though we have transaction fees at all-time lows, so the total block reward in BTC terms is at an all-time low, we have an all-time high in mining investment, and it really is quite incredible. At the Bitcoin 2020 conference, I personally was totally amazed by the sheer number of mining outfits, whether they're people providing mining services, selling ASICs, selling equipment, auxiliary equipment to go around the ASICs, cooling towers, all of these things. I personally was absolutely amazed by the sheer number of them. There were so many, and it kind of shows that even though we've had this kind of reducing block reward over time, the total revenue that's available to miners in the price that actually matters, which is fiat denomination, we're actually seeing that the investment continues to push everything towards all-time highs. So that's just an interesting, again, a more fundamental thing that's somewhat connected to price, but also gives a little bit more understanding about how the Bitcoin network works over the long term. So to close out, we're going to come back to, now we've done a few fundamental stories, let's close out on what we can really do and what tools we can use to essentially look forward, right? What are we looking for in the coming weeks? So what I have here on the left is our long and short-term supply. So this is the division between 0 and 100% of how much of the supply, excluding exchanges, this is only coins outside exchanges, how much of the supply is held by long-term holders in blue, by short-term holders in red, in profit for both of those cohorts is in the darker color, and in loss is the lighter color. And I've also got our percent supply in profit. Now, what I'm trying to assess here is we've already established that it's mostly the hodlers in this market. So what we now need to assess is how sensitive do we think they are to price? What are some of the mechanisms that might force them to sell? What are the things that can continue to create headwinds or tailwinds for the market moving forward? So the first thing I want to highlight is if we look at both of these blue curves together, so this is all long-term holder supply. Let's actually just zoom in on the last 2 years. Keep it really, really concise. Note how we really haven't seen that much selling. Now, there's always coins migrating into long-term holder supply. So the way I'm interpreting this is that we've kind of got this equilibrium of every coin that goes into long-term is being balanced by some long-term holder that's spending. We've got this equilibrium. So at the moment, it's not the most bullish thing in the world because we are seeing that spending continuing to go on. But it's also not the most bearish thing. It very much speaks to, quite literally, equilibrium because we are trading sideways on this metric. There's just not much delta. There's not much change happening over time. So generally speaking, it kind of supports sideways prices at this point in time. To me, that feels the most like it makes the most sense. Now, the second thing I want to highlight is note how wide or how deep the light blue zone is. These are long-term holders who are at a loss. I might actually have to zoom out just one more bit just to capture this, this next insight. So in terms of the long-term holders at a loss, note how deep it is. Note that it's pretty much the same depth from the top to the bottom as the amount of sell side they applied to put the top in. So the other way to think about that, the amount of long-term holder supply that's currently held at a loss is about the same as the amount that it took to put the top in. So if they panicked, not so great. But right now we haven't seen them panic, right? So we're kind of just picking all these different observations to try and build a bit of a risk profile. So the other thing to pay attention to is, yes, that may seem scary initially, but let's look at 2018 or 2019 and then March 2020. Long-term holders were holding almost 3 times more coins in a loss. So they've been through worse, right? They have seen worse events in the past. And of course, the long-term holders are going to be different people, new people, it shuffles around, but we can at least see that we've been in much worse positions in the past. And that's where we can jump across to our percent supply and profit. And you can see that through historical markets, we've pulled down to this below 50% realm, right, in terms of total supply and profit, which means most coins were actually in a loss. Now, March 2020 was a little bit of an exception, and then again so was June, July. We pulled down to about 72%, which again means about 28% of the supply was essentially at a loss. Much, much less. So if we think about this in terms of a balance sheet, let's think about all of the holders in the network as kind of shareholders in Bitcoin. The balance sheet of how much of their investment is at a loss versus at a profit is right now in much, much healthier shape. Now, remember that we've seen these kind of levels during bear markets. It doesn't mean that it can't get worse. But given that we've had the same cohort of people stepped in at 29,000, we explored this over the last couple of months, and we've seen that those same cohort have reaccumulated and seen value at this level, it is possible that those same shareholders could very well be putting in another floor, and it just takes time. It's a process. But we also need to be very aware of the risks. So that's kind of a more bullish case, right? We're seeing the accumulation, the balance sheet's in better condition, long-term holders are at equilibrium. So that's all reasonably constructive observations. Now let's move and look at what are some of the bear cases. And this is where we're going to focus a little bit more on our short-term holders and then our realized profit and loss to close out. So let's actually zoom right in on this section. So with our short-term holders, during this correction, we actually hit 100% of short-term holders in loss. So at the lows here, when we got down to 33,000, every single short-term holder coin was at a loss. They were all holding coins underwater. Now we've retested this level on a number of instances. Generally speaking, that maximum pain of short-term holders at 100% loss really only happens in a handful of circumstances. And it's normally when we're getting towards the worst of the overall correction. Now, as we saw our rally, which got up to about 47,000, note how much of the short-term holder supply, came back into profit. These are people who accumulated the lows. So we know that a very, very significant amount, here we're looking at 13% of the supply, was essentially accumulated by these short-term holders. They stepped in and they saw value down there at those lows. And we really didn't have to get too far above this consolidation range to essentially establish just how much coin supply is now held by those short-term holders in profit. Now, what is concerning is when you see that the price pulls back and we're now back inside this trading range at 40,000, see how many of those short-term holders returned to a loss. So we can see that they're in that realm where essentially price is oscillating around their cost basis. We're seeing that a great number of coins are moving in a profit, out of profit, into profit. And that psychologically can be challenging for people. And we can see that when they move into a loss and they're short-term holders, the probability of those spends does start to increase. So with all of that said, what are some tools that we can use to really track? Are we headed for a capitulation event? When that happens, what does the bottom look like? Do we actually see that we don't need a capitulation event and then we carry on forward? Two tools that I would strongly recommend, and again, we have an Onchain 101 for these, is realized profit and realized loss. So let's just explore these in a bit of detail, but again, I'd certainly recommend jump into that Onchain 101. We explore this in great detail. So with realized profit, note how we see peaks in realized profit at the top, people literally selling the top, cashing out, taking their gains, walking away. And we see it decline at the lows, right? Here's July, pretty much at the lows. We see it spike again, and then it pulls back at the lows, spikes again at the top, pulls back at the lows. So what are we seeing at the moment? Pretty much every rally, relatively small, but we're seeing profit taking following price. Every single rally higher, people are taking profits. So remember, here's people taking profits, which created a downtrend. Here's people taking profits, created a downtrend. So we just have to be very careful about this. We are seeing liquidity coming out of the market as price rallies. And what's important to note is that the profits here are much, much smaller than what we've seen during 2021. So we are seeing that it takes less profit taking to actually put in these little local tops. Again, it doesn't mean it's the end of the world, but it is something to be paying attention to. And it's one of those metrics we can start to see, is there weakness creeping into this space as a result of this? Now, the other one is almost the perfect opposite of that, realized losses. When do realized losses bottom? At the top. When do realized losses peak? At the exact bottom. We see people capitulate at the bottom of these major events when the financial pain is too much and they psychologically just have to release their coins. They can't take it anymore, and they typically sell the bottom. Now, we've seen this decline quite substantially, which again is not what you typically see at a bottom. We're starting to see it tick higher, but this is certainly something to pay attention to. Between these two metrics, we can see profits being realized by the smarter money. We can see losses being realized by those who panic sell the exact bottoms. And what we need to do is really map these two over the next coming weeks just to see how this correction plays out. So we do have a risk of these short-term holders in loss. We are seeing some behavior of profit taking on each price rally, and all of these things are going to create a little bit of a headwind as we move forward. So we've only got hodlers left. We know that they see value down there in that 30, 40,000 realm, but we really need to see, can they continue to hold that line? Do we see an inflow of new users, or do we need to have some kind of capitulation event to just flush it all out? The goal is to be prepared with all of these data sets and just understand what you're going to do if any of these events happen to take place. So thanks everyone for tuning in. I think the takeaway from this session is that markets are a process, not a result. We didn't see the follow through in new activity, new users. We're still in this hodler dominated space. And again, that's okay. These same people see value in that $30,000 to $40,000 realm. But we do need to see something that just kicks us out of this zone. And until then, we still have to go through this consolidation and price trying to find where is the match between supply and demand. So do just be aware of these things, understand the risks. I would certainly recommend spending some time with realized profit and realized loss. You'll find that guide inside the video description below. So please do have a look at that. Our on-chain 101s are trying to equip you with the tools, and we have the bear market survival guide part 1, 2, and 3. And all of these will give you that little bit more edge in understanding how this market works and how you can pay attention to it over time. So thanks for this, and I will see you in the next one. Cheers.